Okay, start from the beginning.
Perfect. All right. So in the first debate leading up to the 2016 presidential election, Hillary Clinton accuses then presidential candidate Donald Trump of not paying any federal income tax for the past several years. To which Mr. Trump responds, "That's because I'm smart." Now, many of you might react the way the media did, blasting headlines for a week about how selfish he is to be proud of the fact he's not paying taxes, how he's not paying his fair share in all the government benefit programs, stuff for veterans, building American infrastructure, support for schools and education, healthcare, all those things that he is not doing his fair share and his duty to his fellow citizens. And I think they kind of all missed the point. And as anyone with even a little background in tax could recognize from, when he actually released his tax returns, I think it was in the past year or so, you could actually see that, like many other wealthy businessmen, he took advantage of 100% legal strategies. He wasn't cheating the system. He didn't have a team of secret accountants and lawyers working, to find the best loopholes. Of course, he had a big team, but he was actually working with legal strategies, and everything that he did was, in fact, actually, I'm going to explain to you, was encouraged by the government. And I think I'll go further and even say that he did more than his fair share, and the other businessmen like him, they do actually more than their duty to contribute to all those government benefits and all the things that government's supposed to be doing that we mentioned before. And today I'm going to show you why. And I'm also going to show you how you guys don't need to be extremely wealthy and have a team of the top-notch accountants in order to lower your taxes. And I'm going to show you strategies, a new way of looking at taxes. And then at the end, we'll get to some actual practical strategies that you can do to lower your taxes and save hundreds, if not thousands of dollars every year in taxes. So to begin with, why are taxes such a big deal? Now, you might not know this, but tax is actually your single biggest expense. So let's say, your tax bracket is going to shift a lot throughout your lifetime. And sorry, just one second.
Is there supposed to be another slide now?
No, we will get to the next slide in a minute. So tax is actually your single biggest expense. And though your tax bracket's going to shift throughout your lifetime, let's say a typical number will be a 30% tax bracket. So if you look at it from another perspective, that's about a third of your working life going towards taxes. So from when you join the workforce in your 20s until you're going to retire in your 60s, a third of all those hours and hours that you spend working is going towards the government. So what I'm going to show you is ways that you could lower your taxes. And the first step of doing that is to start a business. The biggest tax benefits are for entrepreneurs and investors, much more than the regular folks. I'm sorry, this is the next. What slide is showing on the screen now? Only the first slide?
Most of us are afraid of taxes.
Yeah.
Yeah, that's the one. Okay, perfect. That's the one that's supposed to be shown. All right, so everyone could see that?
Yeah.
Perfect. Sorry, I'm going to figure out Zoom a little better. So most business owners are afraid of taxes, and they're afraid of getting it wrong. We're afraid of making an enemy out of the government. We don't want the government coming after us with an audit. It could be very painful for a business, even if they survive an audit. But to have to go through, the government comes in and they send an auditor, they send an agent to look through all of your documents, and they tear through all the evidence. And even if you don't end up facing serious penalties, it's still a huge hassle and a pain to go through. And every business owner has a fear of, we do not want to get audited. And of course, the tax law is complicated. There are a lot of legal speak in the tax law. And anyone who doesn't have, a background or an education in taxes is not really going to be able to open up the IRC and know what they're reading. And as human beings, we're afraid of things that we don't know. We're afraid of the unknown. So if you guys kind of feel what I'm saying here, you kind of feel that same thing where you look at taxes as, something you just want to, you don't want to get it wrong. So you hire an accountant. It's more of an expense to you rather than a big investment because it's not adding so much value to your business, except for the fact that now you're not going to make so much mistakes. So it's what we call in the biz, it's called compliance, right? You just want to comply with the tax rules. And therefore you have this expense that because you have to pay taxes, so you either need to buy a software or find an accountant or learn how to do it yourself, whichever one is going to be easier for you, but it's an expense. So if you guys kind of feel that, what I'm saying, just write yes in the comments below. We'll see in the chat if people are feeling what I'm saying. Perfect. So all of us are, we all, unless you're going to go run away to a mountain somewhere and join a militia and hide from the government, we are all playing the game of taxes. And if you're playing the game anyways, you might as well play to win. And like I mentioned in the beginning, you don't need to be rich like Donald Trump or like Elon Musk in order to take advantage of tax strategies and lower your taxes. And all you have to do in order to play and win the game of taxes is you have to know the rules and you have to follow the rules, just like any other game. Think of it like a partnership. There are two types of partners. One is a passive partner. He just contributes his money to the partnership, and the general partner, the other people in the company, are in control of the funds. They decide how much is needed. They decide where it goes, how it's spent, all the managing decisions. The other type of partner is an active partner. He's someone that does more than just contribute his money and sit back, but he actually takes an active participation controlling what happens in the business, where the funds are directed, where the money goes, how it's spent. So those are the two ways you could play the game of taxes. You're anyways paying taxes to the government. Every month you get if you're just a worker, every month you get a paycheck. You'll see that withholding number. The government has already taken their chunk out of it. You get what's left and you have no control how it's spent, where it goes. Of course, we have the power to vote and choose our, and for the people, by the people, but we don't have such direct control of what's in all of those huge spending bills. The other way to look at it is to learn the rules of taxes, learn how to follow them to gain a lot of riches and become an active partner where you actually take control of how you're taxed and also how your tax money is spent. And I'm going to explain what I mean in a moment. So we're going to get to that. But to understand the game and to understand the rules of the game, we kind of have to look back at how the game started. So originally, when America was founded, it was created to avoid, the part of the plan for America was it was going to be avoiding high taxation. In fact, we all know the story of the revolution with the Boston Tea Party, with all the taxes on teas and all the protests of high taxation without representation. So the founders, when they created the country, were very cautious about tax. And actually in the Constitution, they banned any direct taxation. So instead of an income tax, the government still needs to have revenue to pay for all the government expenses. So they use something called tariffs. Tariff is basically when you impose a tax on specific items like grain or whiskey, maybe on the trade of those items or the import and export, instead of just directly taxing people's income. And a lot of people don't know this. There was actually a revolution that started. A bunch of Pennsylvania farmers burned down a tax collector's house. And in the end, the Congress had to send in a military and the army had to come in and quell the revolution. And that was all over a whiskey tax. So never get between an American and his whiskey. It wasn't until America had heavy debts from the Civil War that they made the first income tax. And it wasn't until after World War I, again, after a war, wars are expensive, and the government realized they need more revenue. So they created the 16th Amendment, and in 1913, the income tax kind of became part of the America the way we know it today. And now the income tax is actually the largest source of federal government revenue. But after World War II, the government started noticing that taxes could actually influence the way people behave. And it started with John F. Kennedy, who was facing a recession during his presidency. And he decided, in order to stimulate the economy, he's going to give a small tax incentive for manufacturers, which was the big industry in America then, so that they could buy more equipment. And it worked spectacularly. Instead of the government having to do all kinds of stimulus packages and pour money into the economy themselves, by giving small tax incentive, it ended up doing the work for them, where a lot of people looking for that special tax benefit were actually making the investments that the government wanted and needed them to do in order to boost the economy at that time. And again, you had high inflation in the 80s, and Ronald Reagan did a very similar thing. He made the first big tax act, and there was a lot of deductions then for real estate. And he was able to avoid getting into a recession during his presidency. So nowadays, governments all around the world, in most Western countries, you could actually look at their tax law, see where there's tax credits, tax deductions, depreciation, whatever it is in each different country, and you could see where those governments have their priorities and where they're putting their emphasis of where they want people to invest in, which industries they want to boost business. I'll give you an example here in America. We'll bring back the example with President Trump. He's a big real estate guy. So in 2017, when he passed the Tax Cuts and Jobs Act, there was a lot of extra special benefits for people investing in real estate. Now you have President Biden, and he's very into the future of electric vehicles and solar and clean energy. So there, if you look at electric vehicles, there's credits for that, and there's also big credits for solar. You might have noticed the solar panels popping up in everybody's houses. Usually the way it works is whoever owns it, whether it's the company or if the person wants to finance it, the owner of those solar panels get huge credits, which makes it a lot cheaper for people to invest in the solar panels. You could basically look at it, again, like that example of a partnership, where the government is agreeing to partner with people and invest with them, not by contributing money, maybe, but instead by letting them keep more of the money that they earn. If you invest in the things that we want you to invest in today's day, there's big ones like I mentioned about solar. So the government's saying, if you invest in solar, we're going to invest with you because we want to encourage more investments in clean energy. Now, if we want to look at how we could find areas that we could save on taxes, maybe solar is not that's our business has nothing to do with solar. There are many more tax incentives, and the best way to find them is by understanding how it works and understanding what the government gains out of it and how it actually is a win-win situation where the government wants us to become rich and wants us to create those investments that they can get more out of it. So what does the government get out of this whole deal? The government's main responsibility is keeping the peace. And the best way to keep the peace and not have everybody rioting in the streets and throwing over police cars and starting revolutions like those Pennsylvania farmers is to make sure everybody has food, has a place to live, make sure everybody has a job, they have money, they could afford the basic necessities of their life. If you look around the world at some of these third world countries that are poor countries and people are struggling day to day to live, they're not happy. And it's very easy for them to turn against the government and cause a lot of problems in the streets. So the government's responsibility, keeping the peace, translates to all these extra areas. Now, the government could pay dollar for dollar. They could hire someone and now this person has a job. He's not going to be, he's going to be much more peaceful. He's going to be happy now that he has a job. And the government, for every dollar the government pays this employee, this government worker, that's $1 of taxes they collect going to that employee. The government wants to provide shelter for people. The government could start opening up government housing. Who wants to live in government housing anyway? So instead, like Reagan and like Kennedy, what governments realized is instead we can give incentives for investors to invest in real estate. Or maybe like in New York now, there's a big thing with the opportunity zones. So they said, we want to make these certain areas in our city, we want to change it from a bad neighborhood to a good neighborhood. And for that, we need investors to go into those neighborhoods. And it's a bigger risk to go into a less popular neighborhood. So the government says, we'll give you special credits if you take that risk. So instead of the government paying to make nicer homes there, they give the investors the credits. So instead of building a $100,000 home themselves, they might give you $20,000 worth of tax benefits or deductions or depreciations that the investor can get more money out of the deal than investing in another area or whatever it is. Essentially, the government's paying you or partnering with you to make those investments, and then you and the government both reap the rewards. You become richer if your investment goes well, your business goes well. If you create, you get richer, you pay more taxes, more money, more taxes. You're creating jobs, all those people that have to buy the house, all those people that work in your business. So more jobs, more people that have more money, again, more revenue for the government, more taxes, and bonus, those people are busy with their jobs. Hopefully they're not rioting in the streets. So resources, almost all wars around the world, not the one going on today, but are started because of a fight over resources. So the government has a lot of tax benefits for oil and gas, like we mentioned, solar, all kinds of energy investments. In all these areas, it's one big win-win situation. The government partners with you so that you get better deductions if you make the investments and you run the types of businesses they want you to make. And then the government also wins because you're doing what they want. And you're making more tax and more revenue for the government. So besides for all the special areas of investing, any business that you run has a lot of special treatment. And most of the benefits go towards businesses. In fact, if you want to get benefits from your investments, usually the way to do it is to think of your investments and run your investments almost with a business mindset to get those same benefits. And we'll bring that up again shortly. So we started today that your accountant was someone that you paid because you don't want to mess up, right? You have the fear of taxes. And because of that, you don't want the government to come after you. So you have this expense of paying for an accountant or a software or a CPA or learning how to do it yourself. But if you find a good accountant, if you find someone that's not just doing your taxes, but is actually becoming a trusted advisor, then it's going to become an investment. It's not paying an expense of an accountant, but you're now going to be investing in a good advisor who's going to show you how to lower your taxes and save much more money. And you could take that money and put it back into your business, back into your investments. So how do you find a good advisor? Someone who could show you how to take most of those, more and more of those credits and take advantage of the most benefits. Well, first of all, you need an advisor that's not afraid of the IRS. At Munitz & Co., we always tell our clients, you don't speak to the IRS. They call you, you send them to us, we deal with them with you. You probably also want an accountant. By the way, most accountants are going to know more than that agent on the other side of the phone, especially now with the 80,000 new IRS agents they hired. They're getting people off the streets with barely any training and sending them out. Most of the time, the accountant is going to know more about the laws and the taxes and the IRC than that revenue agent. So that one's not saying much. You need a guy who's not going to look at the government as your enemy and be afraid of the government, but is going to understand how to be creative, think outside of the box, and show you legal ways to save taxes. For example, you go to your accountant and you ask them, can I deduct this? Let's say it's a vacation. And your accountant's going to say, no, you can't deduct the vacation. Just because you're doing a little bit of business when you get there doesn't mean you could deduct the whole trip. A good accountant, someone who's going to be your advisor, is going to look deeper. And we always tell our clients, ask the better question. Not can I make this deductible? Or not is this deductible, but how can I make this deductible? Because maybe the way it's set up now, you can't deduct it. You can't take advantage of that credit, of that deduction, of that depreciation, whatever it is, of that tax strategy. But what a tax strategist will do is, okay, what do we need to change in order to make sure that you qualify? What will we need to do different? Maybe it means a different business entity. Maybe you need to change around your itinerary for that vacation. So a good CPA could be a tremendous investment for your business. So if you guys kind of followed with me, and now you look at the opportunity of having a trusted advisor as something that brings value to your company, not just an expense, I want to see in the comments, write value. So I know that people are following along and kind of took that journey that we went through. Amazing. So now let's kind of shift. That was kind of a mindset shift of understanding what, like I said, that story in the beginning of Donald Trump saying, I don't pay taxes because I'm smart, right? So now you see that, yeah, he's being smart instead of just being like, passive. He's actually becoming an active partner with the government, and he's looking at all the creative ways and asking the right people, the right advisors of how he could take advantage of the most benefits. And like I mentioned, he's not cheating his way out of paying his dues to the rest of the country. He created jobs, he created real estate. Him and any other example of these wealthy people that you're going to say, sure, some of them are cheating, but a vast majority of them, they're doing it 100% legally. And instead of paying the government the money, and then the government puts it into all their programs, they're putting the money directly into the programs. Instead of just paying their taxes, being a passive partner, they're still giving the government what it needs, but they're being an active partner and putting it directly into those programs that the government is trying to encourage anyways. So it's a win-win for everyone. So now let's kind of shift and go into the actual tax strategies, and maybe we'll mention some strategies that are specific to, people that are just starting a business and don't have a lot going on to make any kind of wild strategies, but something more basic for beginners. So before we get into that, there's something you always need to keep in mind when you're taking advantage of any tax strategy. And that is that these tax strategies are for people that have businesses, or people that are investors. The good news is you don't need a lot of money to start doing this. You just need to be able to behave like a business. So if you want to be treated as a business, you have to behave like one. Just going and, setting up, oh, I'm a freelance graphic designer, and then you don't actually act like a business or do any of the things you need for a business, you're not going to be able to take advantage any better than somebody getting a W-2 from their employee. So individuals get the least favorable tax treatment. They're the most passive. They go to work and the government takes money from them, and that's it. Someone who has is already self-employed, it's a little bit better, but in most cases, not much. It's once you start acting like a business and you start acting like an investor that you get the best tax treatments. So you have to make sure that you're behaving like one. And that means you have to have the proper entities, whether you're going to choose to do an LLC or a sole proprietorship or a corporation. You have to make sure you file with the state, you file with the government, set it up legally. You have to have proper business activities, and you have to document everything. You're probably going to hear me say this a lot, but those are the most important rule for any of these is you have to document. Because you always have to be able to prove anything that you chose to do. You have to be ready to justify it before the IRS, and you have to have proper documentation. In fact, most audits, whether they start because the IRS was triggered by some kind of red flag, or whether you're one of the lucky ones that got the random audit. If right away in the beginning, you're organized and you're quick, and they're going to start an audit by requesting a few documents. If you have those really quick, most times that's going to be the end of it. They don't even look further. They see this person's organized. There's not much that's going to be here. But as soon as somebody is struggling to come up with those documentation and struggling to provide whatever it is the IRS requested, then suddenly they smell that there's a lot to gain here. they can get some good stuff out of this person, and they're going to dig, there's something fishy if the company's not organized, and they're going to dig much deeper. So always document, keep receipts, write notes, and then make sure you know what everything's for, and keep everything documented. There's a concept in legal terms called a corporate veil. So one of the strategies people do to protect themselves is they create a separate legal entity for their business. Let's say an LLC is a typical one. And that way, if somebody sues the company, they're not able to come after the owners or shareholders' personal assets. So if somebody sues Munitz and Co., most likely they're not going to be able to come after Shmulie Munitz's personal bank account. So what lawyers try to do when they're suing is something called piercing the corporate veil. The corporate veil is that thin protection between your business being separate from you. If the lawyers are able to prove that you treated your business as personal activity, maybe you mixed your personal funds with the business funds, maybe you paid personal expenses from the business, whatever it is, you didn't act like a proper business, then they could pierce the corporate veil and they could come after your personal assets. It's very similar in taxes. So if you want to be able to use a tax strategy and use it properly, you have to behave like a business. You have to keep up that veil of this is business stuff, business expenses. Otherwise, the IRS is going to take back whatever deductions you were allowed and give you a lot of penalties. So always make sure that if you want to be treated as a business and get the special tax treatment, you behave like one. So we mentioned before, a good tax advisor is going to show you how you can make something deductible. In other words, a good tax advisor is going to think outside of the box. What could we change around? What could we do differently to fit getting the advantage? So what's the biggest advantage that a business has over an individual? The number one, probably biggest tax benefit right off the bat. You don't need to do anything special, just having a business. And that is the business, deductible expenses. An individual, he earns his money. The government takes their cut. In fact, probably, before it even comes to you, the government's taking it out of your paycheck, and you only get to spend what's left. So you want to pay for rent, you want to pay for mortgage, you want to pay for clothes, whatever it is, you only get to spend all those expenses after the government has taken their taxes from your income. A business is treated the exact opposite. A business earns its profit, then the business could spend on any of the business expenses that were caused by earning that profit and only pay taxes on what's left. So the good news is that there's 4 simple tests that any business expense has to pass in order to qualify as deductible. The first one is that it has to have a business purpose. Pretty simple, any kind of business reason. So let's take that trip to the Bahamas. Let's say you're going to the Bahamas because you want to meet a new vendor that could source materials for your product at a cheaper price. That's a good business reason. So it passes that test. Number 2, is it ordinary? An ordinary expense is something that's typical in your business, in your industry. So if in your business, it's typical to go in person and meet this new vendor and take them out for a steak dinner on the beach, there you go. You've passed the ordinary test. Number 3, it has to be necessary. Necessary is also a simple one. A business exists to create profit. So a necessary expense is an expense that's purpose is to create profit. And number 4, like we mentioned, you have to have proper documentation. If you try and deduct an expense and the IRS asks for the receipt for that expense or the payment for that expense and you don't have it, it's not going to fly. You have to document everything. So again, that good accountant will be able to take a look at your trip to the Bahamas and say, okay, if you change your itinerary a little bit, that's a little bit more detailed for the scope of this webinar, but we'll go through all those 4 things and show how it could meet all the requirements to make that trip deductible. Probably you're going to have to change that itinerary, spend your hours of when you're doing business a little differently, but a good accountant is going to show you the options, not just tell you yes or no. All right, now let's get into the exciting part of the first strategy that I think could be very useful for a lot of business owners here. I want to see in the comments how many of you,
Somebody asked the question, by the way, Shmulie, if you feel me.
sorry, I wasn't following the chat here. Can a bank receipt count? A bank statement? It gets specific of if they're going to accept it or not. But I think a general rule is you usually want to keep a receipt for it and write a little note what that expense was about. If you only have, the bank statements, if it doesn't show clearly what this expense is about, you probably want to have good bookkeeping as well that keeps track and marks this bank statement connected with this expense. Write a little note. Like in QuickBooks, it's easy. You could track each expense and just mark a little note of what it is. Does that answer your question?
I lost service for 10 seconds. I'll rewatch it on the recording.
All right, perfect. So how many of you, most people here, I'm assuming, have a spouse that either works in the business or owns the business, or maybe they're not officially working for the business, but your spouse probably does a lot to help you with the business, whether it means talking over a business strategy over dinner or helping you write emails or manage your social media, any kind of thing like that. If you have a spouse that's doing this kind of involvement for your business, just write spouse in the comments in the chat.
Doesn't look
Okay.
like too many.
Oh, it looks like there's a few more. All right. So I'm going to show you a cool tax strategy that you could use to take advantage of your spouse's involvement in the business. This strategy is going to be best if you're running your business as a sole proprietorship or a single member LLC. And the way this strategy works is that you hire your spouse as an employee of your business, not as an owner. For owners, there are separate strategies. For this one, it works best if they're an employee. He or she is an employee of the business. And then instead of paying them a salary of cash, you pay that spouse in tax-free fringe benefits instead of using wages. So this becomes a deductible expense to the business because you're paying an employee, right? Paying for your employees for sure meets all four requirements. It's business purpose, it's ordinary, necessary. Make sure you document it. And we're going to get into the requirements for that a little bit later for the strategy. So that's kind of the way it works. Your spouse could use these benefits to pay for expenses that would have been personal expenses, stuff you're already paying for, and you're able to pay it. You're able to pay it from the business as a tax-free benefit. So now you don't have to pay taxes on that income, which could add up to hundreds of dollars a year, maybe even thousands. So just a quick thing, hiring your spouse as an employee is actually simpler than hiring a typical employee, because in most states, there's no need to file payroll taxes or employment tax returns or even to file a W-2. And in most states, the minimum wage laws don't apply if it's a sole proprietorship business owner that's hiring his or her spouse as an employee. Some LLCs might have minimum wage issues. So you always want to ask either your tax advisor or legal advisor to make sure that in your state, there's no special requirements. So it's pretty simple to set up that you could hire your spouse as an employee, and there are a lot of benefits. And as we're going to discuss, you have to, like we said, if you want to be treated like a business, you have to behave like a business. This person has to be treated like a real employee, or in legal terms, the bona fide employee, and have reasonable compensation, which we're going to get to in a minute. Let's first get to some of the actual ways that you could pay your spouse as an employee of your business, deduct it, and not pay any income tax on those expenses. So the first one, and usually the biggest one, is paying for healthcare expenses. You would set up something called a medical expense reimbursement plan, or MERP. If the spouse is the sole employee, you probably want to look at something called a 105 HRA. Now, the way this works is the spouse will purchase healthcare for the family in their own name, make sure to do it with their own separate funds. So you want to do it with, a bank account just in your spouse's name, and they take the healthcare plan under their name and they cover the whole family from their account. Then you, as an employer, reimburse your spouse for any of these medical expenses. So even if you are being covered by maybe healthcare from an employee, or maybe you have a lot of government assistance for your healthcare, you could still take advantage of this by paying for any out-of-pocket medical expenses, any co-pays, or let's say you're going to an out-of-network doctor, or maybe you're just going to visit the chiropractor. Always check and make sure with your advisor that what you're doing is going to fit under the bill of a healthcare expense. But you can cover all those things as a benefit, tax-free benefit of being reimbursed for your healthcare. If anybody here is running a S Corp, they have their business as an S corporation, this particular strategy is not really going to work, the 105 HRA, but there is a separate strategy special for S corporations that maybe we could get to, you could in the Q&A session at the end. All right. So the next big one is education. Now there's a caveat for education. So it has to be job-related education, something that's required to keep your present job or salary, something that has an actual legit business purpose. So if it has nothing to do with your business, you're learning a totally unrelated skill, you're not going to be able to cover it as a education benefit. And it has to improve your skills in your present work. And as seen especially in court law, and by the way, a lot of taxes, we mentioned before how tax law is complicated. So one of the reasons it's complicated is the tax law is pretty vague, and you have to be following the decisions that are made in the tax court. So, the accountant's going to say, I think you're able to do this. The IRS is going to say you're not able to do it. And it's going to go to court, and whatever the court decides becomes the official way to interpret the law, becomes the precedent going forward. So if you're interviewing for accountants trying to find a good one, ask them if they have a way of keeping track of court decisions. There's a lot of good resources that accountants could sign up to, these research organizations and softwares that could keep them on top of all of the latest tax laws. So you kind of see from tax court that it can't really qualify for education if it's something that prepares you for another job. So anything that is undergraduate or graduate, let's say you're getting a master's degree or bachelor's degree, you usually won't be able to pay for that as a tax-free expense. But if you're going to seminars, you're going to webinars, you're taking courses to improve your skill on the job. Let's say your spouse is helping you in your graphic design business and they take a course on social media management because they're helping you run your social media account. You could actually deduct that as a tax-free expense. Next one is a cool one. It is a work condition fringe benefits. So things that are needed in order to work could be deductible to your employee, in this case, your spouse, as a work condition fringe benefit, and you wouldn't pay taxes for those expenses. So let's say your smartphone, you could pay your phone bill, your spouse's phone bill from the business as a reimbursable expense. So let's say, you're paying $50 a month for the phone bill. So over 12 months, you're going to be seeing all that money as a tax-free expense. So you could deduct against it from your business income. The last one that you could do is called de minimis. De minimis is a fancy and totally unnecessary Latin term that the tax law uses just to say minimal. So small things that benefit your employee. So occasional meals, snacks, gifts. You bought your wife flowers and she works for your business. That could be a deductible expense. Maybe it's a ticket to a sporting event. Those small things that you do as, minimal benefits to your employee could all be counted as de minimis tax-free benefits. So I don't know if all of these apply to everyone, but here's 5 things that you could take advantage of. Some of them probably more or less apply to different people. Oh, I skipped the life insurance one. All right, life insurance, sorry. Employers are able to provide employees up to whatever, reimburse them for the expenses that they pay into group term life insurance that has benefits of up to $50,000. The only thing is that the employer cannot also be a beneficiary of the plan. So if your spouse is getting life insurance, group term life insurance, that gives them up to $50,000 in benefits, then, the premiums you pay every month could be deductible as the tax-free fringe benefit. So let's get into the rules of how you could make sure you could do these strategies without it backfiring on you and, having to face penalties of doing them. So in order to prove that your spouse is a bona fide employee, just a fancy word for saying a real proper employee, a written agreement is not going to be enough. So if they sign a contract and you pull out that contract and show the IRS, wait a minute, no, I could deduct those expenses. He or she is my employee. It's not going to be good enough usually, and it could actually backfire because you have to stick to the contract word for word. And if you don't, then they can get you on that. So what are the things that you need to keep in mind? To be a real employee, your spouse cannot be a co-owner of the business. They can't share title in any business asset. So if your business owns buildings, property, intellectual property, vehicle, any of those business assets, your spouse can't have title. Her name can't be on any of them. You need to make sure to keep separate bank accounts. So your spouse can't be spending for personal stuff directly from the business account. She has to have a separate account, and the employer pays the spouse from the business account into the personal account. Any contracts or government filings have to be, if it's from the business, it has to be in the business owner's name only. You don't want your spouse's name on there because then it'll show that he or she has some kind of ownership of the business. The work that your spouse is doing has to be real. So, common work, accepted work, actual helpful, appropriate work. So if you have someone that's running a daycare and maybe the wife is running a daycare and the husband comes in the morning to set up and comes at night to clean, that's real helpful work. So that's perfect. The next key thing is to track time. You don't need to sit there tracking every minute that you work and what it was for, but just like any employee has to give in their timesheets at the end of the week, if you have your timesheets, that's a huge thing to prove that your spouse is a bona fide employee. So check in, check out, Monday, Tuesday, Wednesday, Thursday, when you came to work, when you left work. Then the next big thing is they have to get paid. So you actually have to document that they earned this much money and you paid them. Maybe you paid them by using these tax-free benefits. We have to show that you paid them, keep a record of it. So they have to submit a request for reimbursement and you're going to reimburse them and show document of that payment. And they need to have a reasonable salary. So if your spouse is just coming, once a day to clean up after the daycare, they can't be making $200,000 a year. That's just not a reasonable salary for such a position. So how do you find a reasonable salary? One way to do it is to go online and you could see the job description, what they're doing, and see what other people are getting paid to do that. Another option is there are companies that can do an RCR report, which is a reasonable compensation report. And you want to document keep a record of how you came up with that salary. So if you went online, you went to Glassdoor or Indeed or salary.com, take a screenshot of the different job descriptions you found and explain in a quick note how you came up with your price so that you could pull that out if you ever need to. Some states, though, are going to make you register your spouse as an employee, fully, and a few might even require paid family leave and disability insurance. So make sure to follow any state requirements. So just to show you again, these are 5 ways that you could pay your spouse tax-free fringe benefits, and these could all add up to hundreds, if not thousands of dollars in savings every year. So if you guys have been following along, I hope that I showed you guys a different way of looking at taxes. Now you look at all those wealthy people and you don't think that they're just cheating the system and getting away without paying taxes. And you realize that everybody's playing the game. You might as well play to win. Become an active partner. Find a good, trusted accountant that could look deeper and find ways that you can qualify for as many credits, deductions, and tax benefits, preferred tax treatment as you can.
Well, let me ask you, I mean, this, first of all, very thorough professional presentation, and thank you. You clearly are very knowledgeable. You give a very specific example here. I don't know if everybody is necessarily part of this is necessarily married. Is there any other simple, I guess, deduction or tax benefit that you could describe that maybe applies? First of all, I mean, it was also very narrow. It's only if you're a single person LLC. So if you're not that you also can't do this. So is there any other type of one? At least could we cover one other thing? I feel like it's
Yeah.
people
So
probably hear
Does
about
it work with virtual assistants?
What's that?
I'm sorry.
Would it work with virtual assistants? Let's say VAs that
So
are non-American.
is your spouse the VA, or you're saying, could you do these same strategies for a virtual
No.
assistant?
Can I use this also for virtual assistant? I have an assistant in the Philippines, let's say.
Right. So the good news is that you don't need to use that strategy, because anytime you pay that virtual assistant, it should be a deductible expense. The advantage with the spouse is that you get the benefit from both sides. You as a business get to deduct it, but if you would just pay your wife with regular cash, it would be a washout. You deduct it and your spouse picks it up as taxable income, and there's no net benefit. So you might as well not go through the hassle. If you're paying a VA, that's deductible expense. If your VA is picking it up as taxable income, that doesn't really affect you. If they want to try and do the strategy, it's not really going to work in their situation because they're just an employee. But if it's you and your spouse, so on the one hand, you have deductions, and then you use the tax-free benefits instead of cash, so your spouse doesn't pick up taxable income. So you get the benefit on both sides. You get to deduct it, and it doesn't become a washout because your spouse is not picking up the taxable income, and it's going towards expenses that you anyways would have had to pay, but now you can deduct them. So back to you, Yeshua. I wasn't sure if there was enough time. I have a second one prepared here that's a little bit more general and not as specific. So how many people here work from home? Either their whole business is run from home, or they actually, have an office that they do some work at home. So just write in the comments. Perfect. You guys are getting it. All right. So the way it works with the home office deduction, I think a lot of people are familiar with this one, that if you have your business run from home, you get to deduct a portion of your business expenses, of your home expenses, as business expenses. So for example, you could pay a portion of the rent, utilities, mortgage, property taxes, internet, even some household supplies like paper towel, hand soap, cleaning supplies, toilet paper. You can deduct a portion of it towards your home office. So there's two ways to do it. One is the square foot method. The other is the rooms method. It depends on the size of your house, which one you want to do. If you have the rooms method is simple. If you have 5 rooms and one of them is your office, and rooms are kind of like you'd see on a real estate listing when it says a 5-room house, it's not going to include bathrooms and stuff. It's just the typical way you count the rooms. So if you have 5 rooms and one of them's your office, you could take 1/5 of your expenses and deduct them. Let's say you use the square foot method. You have 1,000 square foot house, and you have 300 square feet that's allocated to your home office. Then you could deduct 30% of your expenses. So depending on your house is which method you're going to want to use. Now, the IRS is very particular that your home office is used exclusively for business. And there's been some court cases where they were able to prove that people were using their home office for personal stuff. They were keeping their own personal equipment there. They were, hosting family dinners there, and people were getting messed over. So you need to make sure that it's used exclusively for business. In fact, according to the IRS, you can't even walk through your home office to go to another room. So if you're going from your kitchen to your living room and you have to pass through your home office, then you're stuck. You can't use that home office as deductible expense. But what does that do for all of us? Baruch Hashem, we just bought a house and we moved, but we were living in a tiny Crown Heights apartment. There's no way to make any one room exclusively for business. It's just not happening. So the good news is that we did some research, and there are, like I mentioned before, you have to look at the tax court. So they have special, it was passed in the court that if you have a very small space, it's again that fancy Latin word de minimis. So they allow you to be able to deduct your home office, even if you have to go through there sometimes if it's very small. But you still have to be particular not to store personal items in there. There are some cases where someone had a personal closet, and they said you can't use that. It has to be one area exclusively for business. And again, you have to document everything. So keep every receipt, every expense that you're claiming as a business expense. Keep those utility bills. Keep a record of your mortgage payments, your rent payments, whatever it is. So yeah, even if you're in a, that's why I see big deductions for small spaces. Even if you're in a tiny home office, you could be able to use the home office deduction. There are plenty of more strategies that you could use depending on your situation, but it's going to require talking to someone, going to your accountant and asking them. And if they don't want to give you an answer right away, they don't want to be creative, they don't want to think deeper, either consider getting a new accountant or just keep pestering them and asking them questions until they do. I post on LinkedIn all the time, different tips and tax strategies. You guys, my wife Mushky also does. You guys are welcome to follow it, get ideas, bring them up with your accountant. We're on LinkedIn as Shmulie Munitz and she's on as Mushky Munitz. So feel free to reach out if you have any looking for any more tips. Yes, so your accountant is probably the best person to be your tax advisor. There are also special tax lawyers, but your accountant is probably the best person to be your tax advisor for two reasons. Number one, they know taxes. Number two, they already know your situation really well, because if they prepared your tax return, they have a look at all of your entities, they have a look at your business, they have a look at what expenses you have, where you do business from. Instead of having to explain that to a new person, it's a good idea to go to your accountant and use them as your tax advisor. And the problem is that a lot of accountants are themselves afraid of the IRS. And like it's a good example to compare this to is, any Rav can give you could make something usser, but it takes a good Rav to find the heter. That's kind of the same idea. Any accountant could tell you, no, that's not allowed, but it takes a good accountant to look deeper and say, how can we make this work?
Okay, very interesting. Very, very nice presentation. So let's open the floor now for the last couple of minutes. If people want to ask questions, you could either unmute yourself or you could just type in the chat, and the Munitzes will be happy to respond. All right, so I'll start off then. This is not for me. There was somebody who wanted to be here, and he couldn't be here. I know this is very specific, but he's a real estate broker. He wanted to know if there's any well-known strategies that relate specifically to the realtors. If you have any comment on that.
Okay, thanks for the question. So number one would be to look at his entity structuring. Sometimes we can restructure the entities and make sure that the commissions are not going to be subject to as much self-employment tax, which is a pretty hefty tax. Another thing is to really take advantage of the deductions, such as the vehicle deduction, because I assume he or she is going from one property to the next all the time, and I'm sure there's a nice amount there. Again, the home office. And also another thing, if they are structured as a corporation, he or she can take advantage of, it's called the Augusta rule. And essentially, if you rent your home for less than 14 days a year, that income is not taxable. That rental income is not taxable. So what some people do for their companies is they host either staff meetings or staff events at their house for less than 14 days, and they charge fair market value rental rates, and they could pick up that income as tax-free income, and again, a tax deduction from their business. So that's another cool thing he can take advantage of.
Very interesting. Thank you. Thank you for sharing that. Okay, from all the people that are on, Bill, does anyone have any questions that they would like to ask the Munitz for particular tax questions?
I have one. Thank you so much for the presentation. My name's Ari. So I have a small business and my wife has student loans. So if we give her income, then it like drives up the loan amount. But I heard that you mentioned the fringe benefits are only for single member LLCs, but I live in Illinois and if you make a multi-member LLC, then they allow the state taxes to be deducted as a federal tax expense. So would any of these strategies work for a multi-member LLC?
So you're saying that you guys own the LLC together?
She has 1% just in order for us to structure the entity as a multi-member LLC to get that deduction in Illinois.
Mm-hmm. So in this case, because she is a co-owner, the spousal fringe benefits won't really work here. But you can still take advantage of deducting her expenses from the business. So let's say she drives a car and she does business miles, you can still deduct those mileage expenses because she is part of the business as an owner, but not as an employee.
And it doesn't have to be proportional, like 1% or whatever. It doesn't like 1% of the expenses.
No, so it doesn't go based on ownership percentage. It goes more on how involved is she in the business. So if she drives 10 business miles, those 10 business miles will be deductible, whether she's 1% or 50% owner.
Thank you.
Sure.
Hey, I see we have people on. Is anyone else that would like to ask some questions before we finish the webinar? All right, so looks like there are not that many other questions. So before we sign off, though, just I guess for either of you want to just expand on this, and this is being recorded. You know, we will post this to everyone that came, and then we put it on our website. Just again, I mean, I know you spoke a little bit about it before in the beginning, Shmulie, but in terms of, I mean, anyone running a business, and you know, I could see some people being scared to ask these questions from their accountant. I mean, one of the reasons why I wanted to do this was because you came up with this, you know, you framed it and you made it a discussion that seems to me a lot of people, maybe it's taboo. You know, like they almost feel like they're asking something illegal. Like I'm just, you know, you presented Shmulie in the beginning. You really give a very nice presentation, the background of this. But like, just for the people that are listening, and for the people that will watch the recording of this, maybe just how did you come to this, and how give people perspective how they could feel comfortable to open the conversations with their tax advisor, you know, with their accountants or however it is that they could, you know, have these meaningful discussions for their particular situation.
That's a very good question. Yeah, I think the general perception that people have is that, first of all, we have it with anyone that's more successful than us. We automatically think, you know, either they're doing something, they have a magic touch, or they're cheating. You know, to understand that everybody could reach that success if we learn the skills and we try hard. And of course, it obviously comes from Hashem. So the same kind of thing is in taxes. We right away assume, oh, if someone's paying less taxes than me, they're probably cheating, or they have a whole team of accountants and lawyers. But like I said before, you don't need any of that. You just need to know how to ask the right questions. So you would go to your accountant and you wouldn't say, oh, is there a way that I could get out of paying this tax or whatever it is? You just ask them, hey, let's bring that example of that business trip to the Bahamas. You're going there for business. You want to make a vacation out of it. Is there a way to do it properly? So you go to your accountant and you say, look, I'm making this business trip. I want to also combine it with a vacation. Now, I know vacations are not deductible, but what would I have to change in order for like, what are the rules that could qualify it as deductible? And what would I need to change? If you frame it that way, as in like, I know, I'm not trying to cheat, I'm not trying to do anything illegal, but what would I need to do in order to make it deductible? How would it qualify? What are the rules to qualify it? And then they'll be happy to answer you. The way we always set it up with our clients is we have something called an on-call service. We never bill people for the hour when they call us. We always want them to feel comfortable calling, ask us about anything, because they're not going to be thinking of all the, they're not going to know the right questions to ask sometimes. A good accountant will know the right questions to ask. So we had the other day, one of our clients called up Mushky. He's buying new vehicles for his construction company. So Mushky did some research. Different size vehicles, it turns out, have different tax impact. By choosing the right one, they were able to save a couple $1,000s. Like, who would think to ask their accountant before buying some vehicles? But that's the idea. Just always don't be afraid to ask. And if you're afraid of sounding like you're asking for something sketchy, frame it as, what would I need to do in order for this to work? How would it qualify?
Do all accountants see themselves in this way, the way you're describing, or like, in other words, I for me, in a certain sense, accountants are there, they run, they keep your books, they file your taxes for you. This type of advisory, is it typical? In other words, if a person's looking for an accountant, they should just assume that everything you're describing is something typical that a typical accountant thinks of, or this is just certain accountants that get this, so to say.
Unfortunately, I think it's pretty untypical for accountants. I think the nature of most accountants is very much in the box, not kind of out of the box thinking and looking deeper. I see someone else wrote in the chat also, any tips for choosing a good accountant? So kind of what I'd say is, just like when you're hiring someone, interview them, right? Think of a list of questions you would ask them and try and see how they would respond. So give them like a test. Think of a question that you actually have that would require a little bit more of a creative answer, and ask them and see if, they just brush you off and say, that can't be done. And like push them. Well, what would I need to do? What would I need to change? And if they're able to answer you and they're able to dig deeper, then you know that there's something worth going forward here.
Okay. Fine. Very, very nice. Thank you, Shmulie. Thank you. Your wife jumped off already. Ms. Mushky, thank you very much. This was really very professional, very, very thoughtful. You gave a great backdrop to this. I mean, I'm sure there's tons of more strategies people would love to hear. We only managed to cover a small amount in such a short amount of time, but God willing, maybe there'll be future opportunities. Everyone, it's great to see you all again. Wishing you all a wonderful week. God willing, next month we have an exciting webinar coming up. We'll send out an email soon with all the information. Take care, and Thank you.
Thank you.